All right, let's talk a little bit about this. We've seen just kind of some ups and downs in the bond market after the election. We saw bond yields spike. They've settled down a bit, but still, relatively elevated. In your mind, as we look at the bond market going into 2025, are bonds actually attractive right here, or is the equity market more attractive?
We think that the bond market's been overlooked for the last 2 years. There are significant opportunities across the board. And with the backup in rates in the 10-year, it's telling you that we're back to the language, to borrow from my friend at Bond Blocks, of higher for longer. And that means that that's actually a good thing for investors, especially in the fixed income markets. It means that there's higher yields for investors, and there's probably continued strength in corporate fundamentals to support, these higher rates for longer.
All right. So there has been quite a bit of talk about the bond market, especially with yields moving higher after Fed cuts in both September and in December. So I want to ask you, we've heard a lot of notable voices in fixed income, like a Rick Reeder, say that the belly, the intermediate part of the bond curve, that's attractive. Last time we heard from you, you said that high yield corporates, specifically CCC rated corporates, are very attractive. As we go into the new year, in your mind, would you want to be in the treasury market? Do you want to be in the corporates? Is it a mix? Kind of give us a sense of where you see the opportunities.
So we think that, again, backing rates being higher for longer and corporate fundamentals being stronger and continued growth in the economy, we see two things. One, you should be buying credit. Fundamentals are strong. There's opportunities across private credit, high yield bonds, and investment grade corporate debt. And then we think you should be staying short in duration, reduce your interest rate risk, because anything, past the intermediate space in rates is really volatile. So something in the long end, the 10-year, the 20-year, the 20-year space has been down about, 10% this year. It's had a lot of volatility over the last 2 years. We say stay away from the longer dated exposures and stay short in both your treasury and your credit exposure.
Okay, I want to go back to the high yield corporates. We were just showing a chart right there with the return when it comes to high yield corporates. As we go into the new year with the strength of the economy, would you continue to advocate for investors kind of putting their money in there with the idea that there's I would think, a lower risk of default there, right?
Yep, it's our top pick. It's been our top pick the last 2 years. It's one of our top picks for 2025. And the reason is that there's much better quality in those higher yielding bonds. And that's because these corporations and these issuers took the opportunity pre-pandemic to refinance their debt at lower rates, and they've had growth, and they've been prudent about the way they've been managing their balance sheets over these last 2 years. So there's a lot more quality in that high yield exposure, and one of our top picks is actually going all the way out in CCC. Because we've seen it perform year after year with relatively non-event defaults in terms of historical averages. And so with the strength of the economy and the corporate fundamentals and our view on credit, we love that space.
So, Jenna, I do have to ask you, I don't know if you remember a few years back, there was the quote-unquote TINA trade. There is no alternative to equities. I'm looking at the S&P up 25% this year. If you just put your money in an index fund, you get that kind of return. Why would you put money even in CCC rated high yield corporate debt? I mean, that's only a 13-14% return. Why wouldn't you just kind of lean in on this equity market with the rally that we're seeing that I think most people think is going to continue into the new year?
I think fixed income is such an important part of anybody's portfolio and their risk management. If you're doubling back into equity risk over and over and over again, you're really probably just not used to the risk that you're putting into your portfolio for that return. So on a risk-adjusted return basis, you need to be considering some of these spaces in fixed income with your cash, certainly in treasuries. They're backup yielding, close to 5% again. And in corporate space, it's a really good diversifier away from some of the concentrated risk that you're seeing in an index like the S&P 500. It's great to source that return, but you really should balance it out with other opportunities. And now with rates being higher, and they've been higher for the last 3 years, and they're going to persist and continue, we want people to start looking at that. The other place to look at is non-traditional fixed income assets like private credit, where the yields and the return opportunity has even higher potential than public credit. We just launched a product in that space a few weeks ago. Its ticker is PCMM. This is giving investors access to areas of capital investment that they haven't had unless they were a big institution or a high net worth investor. So there's a lot opening up in fixed income, and you really should be incorporating it for a more balanced risk.
You know, Joanna, we do have to go, but right now there's actually a Senate bill proposing that there be an exam that would allow people to become accredited investors and invest in things like private credit and private equity and things like that. If that bill passes, do you see that creating an even bigger boom when it comes to private equity and private credit? We've seen a big boom over the last couple of years.
I think what we're seeing is that, you know, the professional managers that manage this credit have been doing it for, you know, a subset of investors and now that's opening up, and that's really important. So I think as more people interact with these markets and you can access these professional managers like our product does, you're going to see more interest in the space. It's just important for everyone to have the full opportunity set, and private assets are the full opportunity set. In fact, that space in middle market companies, you'd be surprised at how important a component of our economy it is. Employs over 48 million people. There's over 300,000 companies in that. And those companies generate $13 trillion of revenue. So everyone should have access to that return potential.